What kind of people are we talking about when we talk about investors?
Investors, well, typically what we talk about is business angels. So many of our clients will have seen Dragon's Den. So kind of think Dragon's Den, but nice people. You have to remember Dragon's Den is a TV show. Well, Dragon's Den is a reality TV show. It's designed to be, it's designed to capture audience imagination. It's not designed to be a case study in how investors invest in early stage businesses. So typically when we're talking about early stage business equity investors, so business angels as we refer to them, we're talking about people who've been there, seen it, done it, bought and sold the t-shirt, have banked both experience but also a bit of wealth, and they typically like supporting early stage businesses through that exciting bit. A lot of business angels, a lot of investors are bored with operations. You know, the reason they sold out of their business is when it becomes the norm, when it becomes operational, when it becomes humdrum, that's when they sell out, because what they like is building. They like the excitement, the passion, the early stage. And if it's not their business, what they'll do is they'll latch on to an early stage entrepreneur. It's not a great word, but early stage founder who's got that passion, that dynamism, that enthusiasm. And they'll match that with their experience, their connections, their contacts, and their cash.
And would you say that there's one typical type of angel investor, or would you say it's kind of broken into maybe two groups? So some that are happy to just invest and sit back and watch, and some that maybe want to invest but also would like to sort of help advise and, you know, chip in with some advice here and there?
Yeah, so I think there are bad investors and there are good investors in exactly the same way as there are bad and good people. So a really good investor will invest cash, sure, but actually the value they bring is their wisdom, their experience, their connections, their contacts, their ability to short circuit a business development opportunity because they know somebody, because they know things, because they've got experience. They'll chip in advice, but they don't sit on the shoulder of the founder going, you should have done this, you should have done that, have you thought about this? Because that's a pain and nobody wants a pain. A bad investor, and unfortunately there are still a few around, is somebody who will invest money in you, but that money will be conditional upon you buying their services and some way of them facilitating the payback. So case in point, a couple of years ago, I helped a young business out of what would have been a very dangerous investment opportunity, where the investor was investing 50,000 for 20%, but actually the contract that they were about to sign would have given the investor 60,000 back in consultancy fees over 12 months. So at the end of the 12 months, they'd have made £10,000 and taken 20% of a business. And there are a few sharks out there, which is why it's always good to get some advice. But the majority of people are in that kind of former good investor category.
Well, of course, you get that in all walks of life, don't you? In any aspect of anything we do, really. So it's just being aware of that. So with the investment readiness program, what sort of businesses do you think would get the most out of that? So in terms of size, or, you know, where they're at in regards to their development, or even what sector that they're in?
I think generally speaking, particularly the environment that it's in, angels typically are sector agnostic. Now I'm generalizing as angels. You know, when I ran an angel network, or was part of an angel network that was multinational, we had 7,500 individuals in our network. Now that's 7,500 people, each of whom have got their own personal interests, their own geographical interests, their own sector interests, their own stage of investment. So it's really difficult to generalize. But if I was to generalize, investors kind of go in cycles. So 2 years ago, they were all off apps because everyone was developing apps. 5 years ago, they were all off the next Facebook because all new start businesses thought they were going to be the next social media platform. And when that happens, what investors seek is solid businesses who build things and make things and, you know, get their hands dirty. In terms of what type of business would the program be good for, anybody who thinks they might need to raise external funding anytime in the next 12 to 18 months. So whilst it's an investment readiness program, it might be better called a funding readiness program, because we do talk about the things you need to have in your toolkit to raise grant funding and debt funding and equity funding, because fundamentally the building blocks are kind of 80% the same. It's the final 20% in the way it's presented, whether you're pitching for grants, pitching for debt, or pitching for equity. So any business that's thinking they might want to raise money, and the reason I've given that timeline is, generally speaking, fundraising takes a lot longer than people think it will.
And in reference to a lot of these startup businesses, a lot of startup businesses are in a position where they don't necessarily see so far in advance. Is there anything in particular that they could be doing now to, I guess, open their eyes and make them aware of what would be coming? So budget planning, things like that, where they can literally look at where they might be needing that extra input. Is there anything like that that really these businesses should be doing ready?
Yeah, absolutely. So you talked about budget planning, Jenny. I think the important thing here is not profit and loss forecasting, it's cash flow forecasting. And one of the big gaps that businesses fall into, or the traps that they fall into, is they'll look at their profit and loss forecasts, but they won't plot that in cash flow terms. I was talking to a group of businesses this morning, and we were talking about what's going on with the Suez Canal, with that big tanker, and it's blocked something like £5 billion worth of trade. Businesses as they grow tend to require more working capital. So that tanker has got millions and millions and millions of pounds worth of raw materials, product, stock in there, some of which will be owned by and have been paid for by British companies, possibly even some of our businesses. Now, those businesses will have had to pay for all of that stock before it turns into sales cash. So it's plotting your cash flow and trying to predict sensibly 12, 36, 60 months ahead to say, as this business grows, and I need to take on more people, and I need to buy in more raw materials, and I need to invest in plant, machinery, equipment, buildings, how's that going to affect my cash flow cycles? And it's the kind of bottom of those cycles is the absolute bare minimum we're going to need to start thinking about planning to fund.
Absolutely. And what are investors looking for from the companies that might be approaching them?
So there are probably 5 things that investors look for, generically speaking, in businesses. So the first is a business model that they can understand. Something that's a little bit clever, a little bit unique, a little bit different, maybe leverages some good partnerships, has developed some intellectual property, or can get some first mover advantage in the market. So it's the first thing they look for is the type of business and the market in which it operates. The second is scalability. So businesses that can go big and go big fast. So typically speaking, they're not looking for businesses who've got a corner shop and then next year want another corner shop. What they want is a business that's got a corner shop now, and the next week it'll have 5, and the week after that will have 25, and it's got some kind of, it's what they refer to as the hockey stick growth curve. The third and fundamentally most important thing that investors look for is people. Credible, enthusiastic, dynamic, committed people. One of the things that we say on the program, and I say it all the time when I'm talking to early stage businesses, is I don't care if you're not the best salesman in the world. If you can't be front foot, positive, enthusiastic, dynamic about your business, you haven't got a growth business. So you've got to passionately believe in what you do. And investors invest in people, they don't invest in businesses.
It's almost like the word grit, isn't it? If you've got that grit, that determination.
Yeah, you've got that grit, you've got that sparkle, you've got that determination. It's not just about the solidity and the resilience, but it's also about really being excited and passionate and selling that passion. The fourth thing they look for is people who understand money. People who understand what you need, or what you need from them, and what you're going to do with it.
So clarity on the expectation.
Yeah, absolutely. It's no good walking into a pitching event or talking to an investor going, "Oh, hi, I need £100,000," unless you know why you need that 100,000 and how that 100,000 is going to drive you up the growth curve.
Of course.
And then I guess the final thing is they need respect that they're not there for the whole journey. So an investor will come in, buy some shares, support you, get you to a point in time, and then he wants out. I say he or she, but typically he wants out, and he wants to be able to do it all again, because once you start becoming too operational, they kind of lost. They lose their excitement. So they a respect and an understanding.
So one of my next questions actually was in regards to how long do these investors want to be involved? Obviously, I appreciate everybody's different, and a bit like employing, when you employ your team, you're looking for a culture fit as well as, the personality. It's everything. It's not just the skills. So obviously choosing and matching, both for businesses and for the investors is key. But typically, how long would an investor like to be involved for? And I suppose you've already answered that to a degree in regards to depends how fast that business becomes sustainable. Yes. And
so typically 3 to 5 years. So if you pitch to an investor and say, I'll give you an exit in year 3, 4, 5, they'll be mentally thinking what you really mean is 4, 5, 6. But actually, you made a really good point about relationship, and I said it in answer to an earlier question. Investors invest in people. If it's true that people buy from people, and despite what Amazon tell us, the same is still true, investors invest in people, and you have to approach it pretty much like you would a marriage. There's a bit of flirting, then they move into dating, and you try and work out if the human chemistry is right. Because if it doesn't feel right, don't do it. Absolutely. If somebody ever comes to me and says, I'm not sure about this investor, I've got a really bad feeling, my gut tells me, well, if your gut tells you don't do it, then don't do it.
It's interesting, isn't it, that actually, your gut can make some pretty big decisions for you in business. But I think when a business owner is passionate about what they do, they can feel it. It's in their bones, isn't it? So you have got to give that, a certain degree of, give it enough space for you to think about, actually, if this doesn't feel right, it probably isn't. So can I ask then, what sort of financial information would somebody need to present, a small business need to present, both historic and projected? So we've talked about cash flow.
Okay.
What else might you need to be presenting?
So let's assume you've got history. So we're not talking about a brand new start. So if you've got history, we want to see your history. We want to see your last, well, if you've got it, 2-3 years accounts, because we want to know where you've come from. And it doesn't matter if that's bad news. It doesn't matter if your first 2 or 3 years have not been great, or you've been hit by the world's worst pandemic in living memory. The fact that you've got some battle scars is a good thing. So 3 years history. We'd like to see your current trading, so your management accounts. What are you doing now? How are you doing it? And if that's a progression from your previous 3 years, brilliant. And then we want to see your next 2-3 years financial forecasts. So post-investment, what are you going to do with the money, and how's that going to help you grow? And in terms of levels of detail, my advice is always, for your next 12 months, I want to see month by month. Year 2 and 3, I can just see a year. And I'd like to see that presented in turnover. I'd like to see it presented in profit or loss. And I'd like to see it presented in cash flow. Because as I said in an earlier question, it's the cash burn that often causes early stage businesses, particularly tech businesses that take a lot of cash to get to the point at which they're market ready, that often sees them fail.
So when we're talking about these businesses and looking at sort of coming along for the investment readiness program, how old are these businesses typically? So for them to be able to be in that position and ready to move forward, and they're obviously looking at going from sort of second gear maybe up to fifth, and they need that cash injection, that bit of support. How old are these businesses typically? So presumably they're not sort of 6 months old, or are they?
No, they can be. So if I take the last program that we ran, they range from literally naught. I've got a really good idea. I've got some intellectual property. I've got the start of a business plan, but I've not started trading yet. But I know that 6, 9, 12 months down the line, I'm going to need some money. So I want to get my ducks in a row now, right the way through to businesses that have been trading for 15 years, but have identified a new opportunity. So a new growth market that may not be something they can fund out of cash flow, may not be something they can fund out of their existing business, or they want to set up as a new business and they might want to bring in some new partners, and therefore they need some external funding to enable them to do that. So, I'm in danger of saying how long's a piece of string as an answer to every question you ask. Early stage, probably 0 to 3 years is the sweet spot, but I wouldn't want to rule anybody out who's got growth aspirations, who's got a good idea for a new product or a new service.
So what we need to really be thinking about here is that this is absolutely open to all sectors, to all size there, and literally to any industry. The key components, the common denominator, I suppose we could say, is going to be, it's that culture, it's that vibe, it's that excitement, it's that drive, and it's that passion that we're really looking for. That is what these investors want to grab onto. But it's that teamed up with clarity and, you know, really clear vision.
Absolutely right. In fact, if I could bottle that, I'll use that as the intro to workshop 1.
There you go. And in regards to sort of, one of the things I was going to ask was about how to get investors to buy into me and my team. But again, you know, talking through with you, that's going to be all around the culture and then being able to see that actually you've got a team around you that are on the same page, basically. You know, have you shared that vision with your team? Does everybody know where we're going? So would you say that that's pretty much?
Absolutely. So I think it comes down to 2 things. The first of which is the founder, the kind of heart and soul of the business needs to be passionate. Enthusiasm, dynamism, credibility, commitment are the watchwords we use. Now, quite often those are very young people who don't have a long commercial track record to fall back on, and the way they can supplement or augment that is by having an advisory team. So they're not executives, they're not a board of directors, but they're a network of advisors who've got, you know, maybe a few more grey hairs, who've got maybe a little bit more experience and a little bit more wisdom, and it just helps them move them up that credibility bit. So it's the passion and the excitement that hooks people in, and then it's the credibility that keeps them sticky.
Yeah. Okay. And going back to sort of, we talked about typically 3 to 5 years. When the investor is ready to exit, how do they typically do that? So obviously, again, I know it could be a multitude of different options, but would they typically be bought out? Would it typically be that they're phased out? How would they generally be leaving?
Okay, so it's normally one of 3 ways, and it's good to have that conversation very early on.
Oh.
So the simplest and the clearest way is if your investors' aspirations, time-wise and financially, are aligned to the business founders. So the business founder is very overt about it. I want to build this business. I want to disrupt the market. I want to really, really upset my competitors to the point that in 5 years' time, one of our competitors or one of our suppliers or one of our customers says, look, this business is really annoying me. I've got 2 options. I can compete with them or I can just buy them out. And what I want to do is buy them out. So quite often, particularly for disruptive tech businesses, we'll see the founder say, right, I want to build this business to a point that somebody buys me out in 5 years' time. And that's if you can align your founder and your investor, that's great. So you both exit the business at the same time.
Okay.
The other 2 ways are kind of different variations on a theme. One of which is share buyback. So you say to your investor, look, I'd like you here for the first 4 or 5 years of the journey, and then we'd like to be able to say, thanks very much, here's your check, now go off and do it again. So if that's the case, if it's a share buyback scheme, going back to our financial projections again, what we're going to need to show is in years 4 or 5, there's enough cash in the bank to be able to buy your investor back out without detriment to the future growth of the business. And the variation on that theme is secondary investment round. So you may take 150,000 pounds from your pre-seed business angel investor, build to such a point that then you start getting institutional investors interested, and then to ramp up your scale, you look at raising another £1 million, and that's that million then that buys out your early stage investor and gives you some growth funding. Brilliant.
And there's quite a lot of myths around investment and if it's right for every company and how do we know, what type's best? What would you say in relation to that?
That there are a lot of myths. There are also a lot of mistruths. I think what I would say to that is get good advice. There is no one size fits all for investment. In fact, one of the businesses who came on the first half of this investor readiness program in Leicestershire, we've been speaking to after the event because he came into it thinking equity was the solution for his business. it's a relatively mature business in a very dynamic market. And we've done some work with them and actually determined that really equity is not the answer. They're a business who's resourced well enough that they can leverage debt into their business, which fundamentally is cheaper and might get them to where they need to get to at lower cost and lower risk.
And can I ask, in regards to that, because I know that this is often the case that a lot of businesses will think that they do need that cash injection, but actually it isn't necessary. Where would you say the best place is for them to go for some very open and honest advice? Because as a small business owner, it can often be quite a lonely place and you don't necessarily know where to go to. You don't necessarily want to share such personal sort of details around your finances with a friend or even another business owner. So what would you suggest in relation to that? Where should they turn to?
So I think there's any number of answers to that. So every region has a growth hub. The growth hub are full of impartial, funded business advisors, all of whom have got experience. All growth hubs have got generic advisors, and most of them have got access to specialists within the team and within the broader team. So getting that independent, impartial, objective advice. I often say to business founders, get yourself a mentor, whether that's a formal mentor through an official mentoring program, or just somebody who's been there, seen it, done it, whose opinion you trust, somebody you can use as a sounding board, someone, we've most of us who've grown our own business understand that at times it can be really painful, at times it can be really lonely, and at times you can think like you're pushing water up a hill. And having somebody you can just pick the phone up to and say, look, have you got 10 minutes? Just helps ease some of that pressure. So if you've got the opportunity to have a mentor, seek their advice, or go and talk to your accountant. Any good accountant worth their salt will understand the differences between the various types of business growth finance and what's best for you at that time.
I think we're very lucky in Leicester actually to have such a fantastic growth hub. We do have a really great one with, and what I can also say, and I think it's important to share, is that that's actually in confidence, isn't it? So as a business owner, you can talk to an advisor, it's strictly in confidence. That's not going to then get shared. And I think that's a massive worry for a lot of business owners, is that they don't want that to be out there. They want to talk to somebody in confidence and have a really honest, feedback, not tell me what I want to hear, tell me what the truth is, actually what are my options, and educate me on those options so that I can make an educated decision that's right for me and the business,
Absolutely.
So can I ask then, what key questions do you think a business really needs to ask themselves when they're checking if they are investment ready?
Ooh, there's the $64 million question. So questions that you need to address to find out if you're investment ready. Do I have a very clear plan? Do I understand how I'm going to grow my business? So do I know what those levers are? Do I know where the risks are in that plan? So, is it price dependent? Is it market dependent? Is it cost dependent? Do I have the contracts that I need to have secured? So a lot of businesses are very reliant on 1 or 2 or 3 people in the team. And if those 1, 2, 3 people aren't locked into that team, then that business is at risk, because if they leave, the know-how leaves. Is my intellectual property protected appropriately? I'm not going to go down the rabbit hole of patents and whether patents are a great thing. Generally speaking, patents are very expensive, but they're a damn sight more expensive to try and enforce than they are to create. So, but having your designs registered, having your copyright well and truly protected, having your software and your coding and your softer know-how locked up. Simple things like cybersecurity, making sure all of those things are ticked. But it's fundamentally, it's about having a decent plan with some realistic projections and understanding what money you need, what you're going to do with it, and how it's going to get you up that growth curve.
Brilliant. And this is the second time that you're going to be delivering this program. What are the highlights from the first one in terms of the support that you're actually able to give the companies that attended?
I guess for me, the highlight is that most of the people who are on the program have reached out afterwards for some more free help. So we've been working with them one-to-one with 4 of them now as a result. One of them's now finished his pitch deck, he's polished his pitch deck, and he's now gone live out into the market to seek funding. One of them has had some discussions with us around what they should be looking for, and we've steered them away from equity and are steering them to debt. So we're now talking to them about polishing their business plan and honing it for the debt focus. And the third has actually turned what probably would have been a 6 or 7 page pitch deck into one side of A4 that is now much more concise, much more on point, much more focused, and much more likely to get investment. So I guess the high point is that, what are we now, 5-6 weeks after the end of the program, they're all still talking to me.
Brilliant. That's good. That shows that it obviously was very impactful. So to round up, because that was pretty much most questions that I'd got. So unless Jen's got anything, I just wanted to round up and sort of, I guess, put together in a synopsis. If somebody is looking for this, they really need to be looking at the sort of the culture, the buy-in as a business owner, their team, looking for the right fit. They need to be ready to be able to demonstrate cash flow and where they're going to need that, and have be really clear on exactly how this money is going to impact them for the future growth of the business. And of course, be open to ideas. There's more than one way to skin a cat, as they say. So
Absolutely.
Different options as well. So don't be so headstrong on, we definitely need investment, because actually, like you were just saying, there's a company you've done where they've worked the debt into that, which is obviously a better option for them. So it's not one size fits all. It's very much going to be, let's find the right match and actually, match you in a way that works for you and your business.
Yeah, for me, investment readiness, funding readiness is finding the right funding at the right time.
Perfect, brilliant. Thank you so much for answering those questions. That was pretty much everything that I wanted to know. Have you got anything, Jen?
Yeah, I just wanted to echo that. Thank you, Russell. That was so useful. We have FSB has 2,000 members in Leicestershire, each one of them completely different.
Yeah.
So being able to have that kind of one-to-one support and advice and a course rather than just a sort of quick webinar, I think is really beneficial for them.